Shopify grows your business no matter how far or big you grow. Shopify is the global commerce platform that helps you sell at every stage of your business. Whether you're selling your fans' next favorite shirt or an exclusive piece of podcast merch, Shopify helps you sell everywhere. Shopify powers 10% of all e-commerce in the US. Allbirds, Rothy's, Brooklinen, and millions of other entrepreneurs of every size across 175 countries. Plus, Shopify's award-winning help is there to support your success every step of the way. Because businesses that grow, grow with Shopify. Sign up for a $1 per month trial period at shopify.com/income, all lowercase. Go to shopify.com/income now to grow your business, no matter what stage you're in.
Welcome to Accelerate Your Business Growth, where we're exploring all sorts of business topics. Experts from around the world join me, your host, Diane Helbig, for a conversation where they share their expertise with all of you. Take what you need when you need it. Featured on Inc.com, Forbes, and MSNBC's Your Business, this podcast is recognized as one of the best podcasts for small business, sales, leadership, social media, and more. When it comes to business, Accelerate Your Business Growth has got it covered. And now on with the show. My guest today is Addison Adams. Addison isn't just the founder of Adams Corporate Law, he's California's go-to voice on mergers and acquisitions. Addison spent over 2 decades dedicated to closing deals across a range of industries, from formations and pivotal buyouts to navigating the nuances of VC financing, contract law, and corporate governance. He brings stories, insights, and expert tips, and we are thrilled to have him with us today. Welcome, Addison. Thanks for being here.
Diane, it's a pleasure to be here. Thank you so much for having me on your show. I look forward to our conversation and hopefully sharing something helpful with your audience.
I'm sure you will, and I'm looking forward to it as well. Let's talk about, let's start by talking about when a business owner is closing the sale of their business, what are some of the common pitfalls you find that they go through?
Oh, the number one thing is on the sell side, they're not ready. Over and over again, they're just not ready. And it can be basic things like, we need to see a contract with your major customer or your major supplier, your distribution partner, whatever it is. And they say, oh, it's right here. And we say, well, that's not signed. Oh, gosh, it's like they're checking their pockets for where they put their keys, and they got to, track down the signed version of documents. So that's like the low hanging easy stuff to do, is have a file cabinet that actually has the signatures on all the important documents that a buyer would want to see. And then the other one that's a little harder to prepare for, and of course there's more than just 2 things, but the other one is your books. A lot of times, especially smaller companies, they're on QuickBooks. They're using sort of internal, either themselves or more of a bookkeeper. And so they're generating financials that say what their revenue is, what their expenses are, and what their bottom line income is. And yet it's not done the right way. And so a lot of times when the buyer comes in with the actual professionals to scrub the financial statements, they say, oh, well, you're recognizing your revenue incorrectly. You've not done the account receivable correct. You've already, obviously, a lot of companies are running personal expenses through as business expenses. Yeah. That's less problematic as long as it's able to be tracked and sort of reversed in. But yeah, having a financial statement that is accurate is a common issue, and that's why you see certainly businesses that are being sold for something reasonably substantial, which I'd say $5-10 million or more, will get a quality of earnings, which is like a mini audit. So those 2 things are there's more. Honestly, I could talk for 5 hours on how to prepare for a sale, but those are the two easy ones.
Those are good. And as you were talking about the financials, a thought that came to my mind was, I think I heard a couple of weeks ago about, so when small businesses, we're doing our taxes, we want our taxes to be as low as possible. So we can work the numbers so that the profit is low, but that doesn't necessarily serve us well then if we're looking at the value of our company when we're trying to sell it. Am I thinking about that correctly?
Yeah, I think that's, I mean, hopefully nobody out there is committing tax fraud,
Yeah.
so let's say that. But the idea, a lot of times, people get, I guess, a little more aggressive on, um, what's a business expense.
Yeah.
And so this idea of saying, well, that's kind of business related. It's, it was lunch with some of the people in the firm, or, obviously that's a small expense, but so a buyer can, listen to, basically you look at your unadjusted financial statements and you see hopefully a profitable number at the bottom. And, and they say, all right, well, I'm going to give you 8 times, earnings. And then the seller might say, well, actually, great, thanks. Can I have 10 times? That's, negotiating. But also my earnings are higher than they look on paper, and that's where you get into the add back. So you say, well, I've got my main driver is a company car, and kind of go down the list. And so and by the way, these things are, my advice to your audience is pay your taxes and do it right, right? You're not supposed to put your thumb on the scale and drive your earnings down. And so, but to the extent that there's any sort of eccentricities or weird things, unique one-offs, things that should be adjusted and added back, then that's what you need to do. But at the end of the day, excuse me, I'm stuttering here. I apologize. I'm going to slow down.
Right, all right.
The buyer is, most buyers are smart, and they're buying the business, and they're going to figure out the truth of what you have to sell. And so you've got your top line revenue, that should track your financial, your reconciled bank accounts. That should all track with with what's happening with your tax returns. And so you have your top line revenue, your net revenue, go through your operating expenses, your cost of goods, your overhead, and you get to this bottom line revenue. So the buyer is going to be looking at all those things, and they should be, and you should be able to explain everything away or to them so that both sides could get on the same page as far as how much money you made, and that's really what it comes down to. Right. And then, of course, from the buyer's point of view, they're going to the next step, which is once they own the business, what further adjustments are they going to make to, improve the margin, reduce the overhead, and grow sales. And so they're not going to pay you for their plans, but that is part of their thinking.
Right. So. Okay. That's a good point. Okay. That makes sense to me. Is there a difference? Well, I'm asking this question incorrectly. Is it different for manufacturing companies than like companies in other industries when it comes to buying and selling?
There are a number of things unique to manufacturing companies. Okay. For example, they tend to have a lot more raw materials. So inventory is a bigger piece of the overall purchase price. If they're manufacturing with anything that could be, some kind of hazardous material, then you have environmental due diligence, as far as the factory and whether anything's been spilled and whether there's a history of citations or fines, what kind of policies and procedures are in place. So typically a manufacturing company is going to be bought by another manufacturing company. So they're going to have the expertise to know what to worry about and what not to worry about. But, that would be sort of a potential hidden, problem. that you want to make sure there's nothing hidden. It's okay to have a problem because then we can work around the solution. And so, yeah, those are a few things. Every business, I guess it does slide in different general categories. If we're buying a professional services business or some kind of software with recurring revenue business, manufacturing company, or maybe it's more of a sales distribution company. There's a lot of different ways, a lot of different types of businesses, and each one has its own unique set of factors, which boils down to essentially what makes the business valuable. What is the buyer going to be? What's driving this? And so I think it's not as simple as what's making the price the highest. It's also more about what's unique about your business and why would someone want to buy your business versus someone else's. And so, that for manufacturing, there can be the equipment itself can be very valuable, unique molds and forms and dyes and things like that. The people have the expertise, so there's value in the workforce, assuming it's some kind of, skilled requirement. And then always for every business, the customer list is a huge asset. And so the recurring customer list and the pricing margin, all that built in. And every now and then manufacturers have supply agreements that lock in good pricing, good and goodwill, history of timely, manufacturing and delivering of whatever the product is. So all of these things are helpful, to think about. And so if you're running a manufacturing business, one of my great tips is take a step back. Imagine you were buying your own business, and what would you be worried about? What would get you, what would you be excited about? And what would you want to see? So in other words, put yourself in the shoes of the buyer. And, that obviously that applies to every business, but including a manufacturing business. So that's what I'd
great
say.
advice. Yeah, I love that.
Oh,
you have to
okay.
be able to see your business realistically, right, and honestly.
Right. Which is, that's a good observation. Not easy to do.
Yeah.
Right.
Yeah.
And you could miss on the overly optimistic and overly pessimistic side pretty easy. So maybe get a business coach or some kind of advisor out, to give you maybe some objectivity. That's, always a good idea.
Right. Yeah, that's what I was thinking. Okay. And let's talk about partners.
Yeah.
In a business. So sometimes a partner decides they're done. They don't want to be part of the business anymore. Sometimes partners pass away suddenly, and leave the other partner or partners holding the bag, so to speak. But so will you talk about what are some best practices for making sure that the remaining partners are prepared for that, and how do they minimize, I'll say the what could potentially be negative fallout?
Yeah, it's a great suggestion that owners of businesses, especially owners with partners in their business, they should ask that question. They should think about what is my plan for this business? And I would start at the end, which is, what is the end of this business? What's the future? Are we growing it in order to sell it? Or are we growing it in order to just run it as a cash cow deep into our retirement, maybe until we're all just drop dead? And meanwhile, other people have stepped in as executive management to keep running it. Maybe turns into a family business we're going to pass down, over the generations. So having an understanding of what everybody wants, and that part of that has to do with how old everyone is, the owners are, young or retirement age. Do they have adult children that have any interest in the business, or, no children, or their adult children, really would rather not walk in the front door ever? So all these things sort of unrelated to the business have to do with that question. And then I'd say, all right, in order to prepare for this idea of death, disability, retirement, termination, with or without cause, you just quit, or maybe you turn into a bad employee and get fired. Um, we start by looking at the ownership stack of the company, who the owners are. Are they active in the business? Or do you have maybe one or two or three owners that are actively operating the business and fulfilling needed roles? And then maybe you have some silent partners, some, financial investors, that kind of thing. And so we can treat those people differently. And so the general idea, though, of preparing in advance is you have a contract that's signed by the owners. Usually you call it a buy-sell agreement. And in there you say, here's what's going to happen if one of us dies, or retires or decides to leave. And so that normally comes down to one of two options, one of two ways to sort of, slice that or approach that question. The first way is the surviving or the, remaining owners, also known as the company, has the right, but not the obligation, to buy out the departing partner. And usually that'll be a fair market value assessment at the time of the triggering event, time of death, time of retirement, whatever. And that would allow, sort of give the company the choice, maybe just let them or their surviving estate continue on as an owner. Maybe they'll get their, payout if and when the business ever gets sold down the road. Or maybe the company doesn't really want to spend the money. If it's a valuable company and this person has a big piece of it, that might be a big check to write. And so, that could be a problem. As far as making it easier to write that check, the buy-sell agreement can do essentially seller financing and say in the agreement itself, if the company decides to buy out the departing partner, we have the right to stretch the payments over 10 years. And maybe the interest rate, we're just going to agree is something low, 2, 3, 4, 5%, or high, right? This is a negotiation. And then related to that is the idea of funding a buyout, at least on death, with the life insurance policy. And so this is something that we set up sometimes as well, which is basically the remaining groups of partner buy a life insurance policy on the life of the person that might die. And you might do this. If there's 4 partners, then you might have 4 separate life insurance policies, each one sort of bought by the other 3. And then that would then shorten that payoff period, to say, well, we've got $1 million life insurance policy here, so we're going to buy you out, and at least we know the first million's got been covered. And then you can either try to do an updated valuation and update the life insurance proceeds every year, every 3 years, or something like that, or just do it whenever you feel like it, and agree that if the value of the business is more than the life insurance, then the company just has the right or obligation to make the payments in excess. And so that's sort of option A. And then option B is more of a put right, where the departing partner has the right to force the remaining partners to buy them out. And so that is obviously much more favorable to the person that died, got disabled, retired, or got fired, because now they know that their investment is not going to be tied up and sort of stuck there for an indefinite amount of time, but they can, say, no, we're having an appraisal and you have to buy us out. This is not a option. It's a mandatory. And so pros and cons to both of those two approaches, as you can imagine. And it does, you could see if you had one sort of older partner and one younger partner, and you sort of have an idea of how this is going to go out, then you can pre-plan, and this can end up being a little bit of your overall retirement planning is negotiating a buy sell with your current partners. This is how I want this to go down when I retire, or if I die, et cetera, et cetera.
Well, I gotta say that I think one of the things that I already knew because I had a personal experience with it, but that you are confirming is you got to have some sort of buy-sell agreement. There's got to be something there that says what is going to happen in the event of fill in the blank.
Yeah, well, whether you have an agreement or not, there's going to be an answer to that question. And so,
True.
meaning if you don't have an agreement, then nothing happens. You're not getting bought out, and the remaining partners don't have any right to buy them out because that's the default. When there is no agreement, that's the default. You just, the heirs inherit whatever the ownership percentage is. And, so that could be a real fear for the the remaining partners might say, look, I don't want to be in business with the spouse or the child.
Yeah.
This is a concern of mine. I want to make sure that I am not stuck there,
Yeah.
And so, on the other hand, depending on, I guess, the spouses and the children, maybe it's not a concern. And so certainly cheaper to do nothing. But I think it's smarter to, just like having a will and a trust is smart. You should also have a buy-sell agreement. It just makes sense.
Oh my gosh, I totally agree with that. And yeah, well, I used to work for a company that had three owners, a man, his wife, and another woman. And the man and the woman were the ones who ran the business. They were the experts in the business. And the man died suddenly, unexpectedly in a car accident. And they didn't have a buy-sell.
Huge problem.
Yeah. All of a sudden, the two women were working together, and the one had no idea about the value of the business, how to run the business. And so the woman who did was stuck. She was just stuck with this other woman, and they couldn't come to an agreement about what the company was worth. And anyway, it was sort of nuts. So
it's a real disaster. Well, and a good question to ask there. And, the problem is if the two remaining people can't come to an agreement, but if you have the husband who was, I guess with his wife, expert and heavily involved in running the business, that can be hard to replace. Right. And, and so can you fill in the empty shoes with the people who are left?
Right.
Or not, or can you hire someone else to fill in, those shoes? Or is it really maybe a better time to, hire a broker, an investment banker, and let's just go see if we can find someone, to buy this business.
Yeah.
Preferably quick before we sort of run it into the ground, and and that could be real, real smart. And even those two women in that example, maybe they could have continued on working for, the buyer in a bigger company, bigger combined entity doing the same thing, so that can make a lot of sense. I think it often does make a lot of sense. If depending on the expertise and knowledge of the person,
of the people involved. Right. Yeah. It does bring me to some questions about getting financial investors, because I think that's what they ended. I left while they were still trying to figure it out. So I don't know where they ended up, but if memory serves, they ended up getting some financial investors / owners. So what are some of the, I'll say, key considerations for a business owner when they're actually looking for investor financing? So, what I'm thinking about is protecting themselves and minimizing their risk.
So the answer to that question has a wide variety of answers depending on the business itself.
Okay.
And so if you're a family-owned manufacturing company, finding an investor is going to be really hard because your typical tech investors usually aren't going to be interested at all, because normally a manufacturing company has normal forecasted growth. And that's just not interesting or exciting in any way to a
Hmm.
equity investor.
Okay.
That's why equity investors like venture capital or angel investors, they're looking for new products, new software, new technology, things that, the value of the business today is 5 million, but it's like 500 million. Just give it a few years, giant growth. And manufacturing company, those, like I said, normal things. So if you're looking, it's always interesting to me, when you have like a normal business with normal growth, normal profitability, the idea of, well, how do I finance this? And the first answer is, well, if we're just financing normal growth, you go to the bank and you get a loan, you get a line of credit. Um, if you've already done that and you need more money than that, and the next thing you need to do is say, well, why?
Yeah.
Are we in distress? Is this a turnaround situation? And maybe we need to refinance some payables and debts and things like that. But now your investor class is going to be people that know your business. And so it's more of you're looking for wealthy people that already have ownerships in your competitors or, some in the industry that know your business inside and out. And so it's more of a strategic relationship. Sometimes, we close deals where the investor is your main customer, or your main supplier. So they're doing a little bit of like hedging on a vertical integration strategy. And so the financing might come with some kind of like most favored nation pricing, or some exclusivity rights and whatever their specific product is.
Hmm.
So that's where I would look for that kind of a small business is, you sort of already know, probably, you're probably already friends with all the people that might potentially invest in your business and, just through the industry you're in. So as far as protecting yourself, we do handle a lot of investor financing. And so the idea there is, well, I guess maybe I should back up and say, if we're talking about one or two investors making a large investment, it gets a lot easier because now you have someone that is most likely qualifies as an accredited investor, which means they're wealthy enough to be deemed to be able to look out for their own interests. And so the securities law disclosures are essentially limited to just don't lie to them, don't commit fraud, but otherwise, answer their questions, and you can take their money and make a few filings, state and federal, and you're good to go. If you're doing, sort of a casting a wider net, and you're doing more of a trying to find, hundreds of investors, or maybe I'm going to raise $10 million and but the minimum investment is 25,000 or something like that. So you're going to have a lot of investors. That's where you want to have a more robust disclosure document and sort of lay out the whole business plan, lay out a full discussion of the I guess risks and opportunities of the company, and have financial statements that are reliable. And all of that is to protect you from the investors coming back later saying they were somehow hoodwinked into, investing in what they thought was this super safe investment. And then shockingly, the forecasts were missed. And in fact, the earnings went down and stuff like that. So, usually you don't get blowback from investors when things go better than expected. So just planning for the worse than expected scenario.
Yeah.
And that's how you try to protect yourself there. Yeah. And just be, open and communicate. I guess I could also say that fewer investors is always better, because when you have more, you run the risk of running into, a problematic investor, someone that stirs the pot, complains all the time, calls you every day, that kind of
Yeah.
thing. So not all buyers are equal, and not all investors are equal. That's for sure. So on the company side, you want to be sort of following your instinct and asking questions. Can they afford this investment? Do they have other investments out there? These are things that you want. You know, you don't want to take anybody's last dollar, that's for sure, and then have
Yeah.
them get super upset if it like gets delayed 5 years.
Yeah.
So
Yeah. Okay. And speaking of that,
yeah.
um, what are the trends or I guess changes that you see on the M&A landscape that business owners and investors should be aware of? Is there anything coming down the pike?
Well, one thing that's been happening the last 3 years, it seems like, is that as the number of M&A deals, the volume have gone down, and they have gone down. 2021 was the peak, and then 22 and 23 were both lower, and we'll see how 24 performs. There's a lot of private equity prognostication that it's going to turn around and be a great year. And I think it is going to be a good year, but we'll see. But anyways, the trend has been with interest rates going up and fears of inflations, that the overall values have been going down. And that's because buyers typically leverage the purchase price with bank financing. And so if the bank financing is charging the buyer a higher interest rate, then it gets more expensive for them to pay a higher multiple on whatever your earnings are, the business that you're selling. So some of the workarounds that have been becoming more popular on that front are essentially indemnity holdback versus indemnity escrow. And so to explain that, typically you're going to see 5 to 15% of the purchase price held back for a year or two, just in case some unpaid liabilities pop up that the buyer needs to pay. That's really the responsibility of the seller. And so then they'll take it out of that escrow account. And, that could be millions of dollars if it's a, bigger size transaction. So what I've seen is that rather than fund that money up front, we're seeing they'll take that money and they'll just say, like a seller's note, we'll promise to pay you later. And if there's a liability, we'll just pay it. And the amount that we pay you later will just be less. And so that way they can just sort of take that piece of it. And, because the bank's not going to pay very much interest when it's just sitting there in an account. And so they can instead, negotiate that as part of the purchase price is, well, what interest rate are we paying you to just wait 2 years before we pay you the money? Related to that is seller financing. And so if you have a $20 million sale, the offer might come in at, $15 million at close and $5 million over 5 years, pay you $1 million a year over 5 years and negotiate the interest rate directly with the seller. And that's just a way for them to bypass this higher interest rate concern that they're dealing with the banks. And then the third thing I've seen, and this has been getting definitely more popular and probably more like 5-6 years now, is rollovers. And so if the buyer is, and a lot of times the buyer is a strategic buyer, and meaning it's just a bigger fish in your same industry, and they're buying you because they are going to fold you into the bigger organization, put all of their greater resources into your business and growing it as well. And so along with the purchase offer, the structure of the purchase payment would include a rollover. So that's different from an indemnity holdback or indemnity escrow. It's different from seller financing. It's basically a part cash, part stock offer, where in my $20 million example, maybe $2 or $3 or $4 million of it will say, we're going to let you roll over your ownership in the business you're selling us into ownership of the buyer that's buying you. And typically that's going to be, a big company, often owned by a private equity fund or group of funds. And they'll say, as part of the offer, we've already bought, 4 similar companies. We're going to keep buying more companies like yours. We're growing all of them. And then our plan is, give us 5 years or 3 years, whatever their plan is. We're going to package it all up and sell it to someone else, even bigger than us. And so that rollover can be a great opportunity for an owner to get a second bite at the apple, where you say, well, okay, I just rolled over $2 million worth of my equity that I otherwise would have been paid cash. But the hope is that wait 5 years, you're going to get, $4 million worth of money when they sort of flip it again. So those are the 3 trends that I'm seeing lately as far as deal structure goes.
I like that one.
Yeah. It can work out really great. And a lot of times it works out and is coupled with when you have like a founder that's being hired by the buyer to keep running the business that they just sold them. So
Right.
you can get, you might have an employment agreement, you might have some earn out style bonuses tied to performance, and then you also have this rollover, kicker. So it does have a tendency to really align everybody's interest into overall success, growth and profitability of the business. And
Right.
I've seen it work many times. Sometimes it also doesn't work. So paying attention to who the buyer is a big deal.
Yeah.
You want a good buyer that you trust, that's professional.
Yeah.
You don't want someone that's over leveraged and, bunch of hacks. So, you know what I mean when I
I
say
do. I do.
that?
Sure. Right. I mean, it's got to be the right fit first.
Yeah.
Yeah. Hmm.
Yeah,
Hmm.
right. You're right. You got to obviously you want to it is like making an investment in the buyer, so you want to believe that it's a good
Yeah.
investment.
Right.
Right. And if you're working there, you like the culture and like the people. If you're not working there and now it's just an investment, you want to at least respect them and believe in their ability to execute. So,
Exactly. Right. You got to think past the initial excitement of just selling
yeah,
about the
yeah.
future.
Well, and sometimes people are excited just with the cash piece,
Yeah.
and so if normally, obviously sellers try to negotiate as much money as they can, and buyers try to, negotiate it down as much as they can, of course, but now and then you get a price that the buyer is feeling like they're getting a great deal, but that's still even more than the seller's like bottom line number. So, if you were happy at 15 million and you're getting 17 and you're rolling over three,
Yeah.
that's an easy, like, sure,
Yeah.
I'll let that ride.
You got it. Oh my gosh. Addison, this is great. I appreciate it. I think this is really valuable information. That
Good.
yeah,
Good.
that more people need to hear. We don't have this topic often enough. So
Well,
thanks for
if
sharing.
anyone out there is thinking about, selling their business, then
Yeah.
there's a lot of I think there's a lot of strategy that business owners should engage in as far
Yeah.
as thinking long term about their business. It's so easy to get tied up running the business and doing the day to day, but when it comes time to sell, um, a lot of times you might have wished you'd been doing more of this strategic thinking earlier,
Right.
and some of that is legal, sure, and some of it's accounting and financial, but a lot of it is business too.
Yeah.
And just having, understanding like, okay, if people are buying me for my customer list, then I should have I should not have client, like one client that's overly large.
Right.
There's a bunch of things like that that can help improve your
Yeah.
overall value. And also just forget about like the structure at the close. It's how do you get there? So, if there's obviously, it takes a village. And so
Yeah.
having consultants, advisors that give you the right advice I've seen it just be really helpful for owners, to try to just like, okay, my business has got 10 million in revenue. Um, if I can double that to 20 in 5 years and then sell, obviously that's a great idea, right?
Right.
That's the right thought. But, so that's why it can pay in spades to ask the right questions and get the right people on your team.
Exactly. And these aren't things that you're supposed to know while you're running your business. That this is why there's experts out there, right?
Oh, 100%. I
Yeah.
mean, every business owner is an expert in their business.
Right.
Because you have to be. And if you weren't, you become one. That's because
Yeah.
that's what you're working on all day long. The pricing, the products, the people, everything, you're an expert. But we're not all experts at everything, and you should never, you should acknowledge what you don't know.
Exactly.
And so,
Yeah.
yeah.
Yeah. Yeah. Yeah. Critical. Oh my gosh. So how can the listeners find you?
Ah, wonderful. Well, let me start by saying I would love to speak with any of your listeners. We are open for business. We're accepting new clients.
Yeah.
And we're also available just to have a conversation, sort of a free consultation. My name is Addison Adams. My firm is Adams Corporate Law. We are a securities and corporate transactions boutique law firm. So that means that we are sort of mid-tier rates, high value for what the cost, and a smaller firm. You get personal attention. I'm involved in every transaction that we're working with, every client. But we do have a handful of attorneys that are experts in their game. And so you can find us at adamscorporatelaw.com. That's the main website. You can find me personally on LinkedIn under my name, LinkedIn/n/Addison Adams. You can send me an email. That's addison@adamscorporatelaw.com. And you can give me a call for anyone writing this down, 714-619-9360.
Awesome. And that will all be in the show notes and, in the recording. So great. So wonderful. Thank you so much again. And listeners, thank you. You are who we're doing this for. Thank you for tuning in to this episode of Accelerate Your Business Growth, a production of Evergreen Podcasts. Discover more episodes of this podcast and explore others at evergreenpodcast.com. As always, continue to prosper and be curious. And if you're looking to get your sales strategy headed in the right direction, pick up a copy of Succeed Without Selling on Amazon or wherever books are sold. Until we meet again on another episode of Accelerate Your Business Growth, goodbye and good day.
Hey friends, this is Jim Knight, former 21-year Hard Rock executive turned best-selling author and top 10 keynote speaker.
And I'm Brant Menswar, former frontman of Hollywood's most dangerous band turned top 10 motivational speaker and best-selling author.
We host the how-to podcast Thoughts That Rock, where we talk to rock stars, athletes, CEOs, astronauts, and even next-door neighbors who share their expertise and opinions. Together, we tackle the most interesting and challenging topics of today.
Whether you want to learn how to become more confident, how to deal with anxiety at work,
or how to write a hit song, or use Brazilian Jiu-Jitsu in life,
we've got hundreds of episodes to help amp up your life and move you forward.
Subscribe to Thoughts That Rock wherever you listen to podcasts, and check out evergreenpodcast.com for more information.